Hello guys, welcome to the fifth session of this course. We'll be studying two more POIs today. Last class we have studied order blocks. In this class we'll study about mitigation block and breaker block. So they're quite similar, but still there is a subtle difference between them. So we'll go through that, and then I'll also show you some examples on the charts so that you see how market actually respects these two POIs as well, along with order block, which is obviously the most popular kind of POI that we see in the market. Order blocks and fair value gap. Okay, so now let's start this class. So let's say market is moving in an uptrend and we see something like this. So obviously it's an uptrend market. Why? Because market has created a new breakout structure on the upside. So now what's the plan? The plan is to buy once we get a pullback, right? Now there are two zones from which market can actually continue this uptrend after the pullback. First one is this fair value gap and order block, which can be considered as one single POI, right? So this is the first zone. Let's mark it as order block OB. So this is the zone obviously that will be looking for an entry. We have already studied about order block and fair value gaps, and we know how to use time frame alignment to look for an entry from this POI, right? But you will see that sometimes market does not actually come all the way to the order block before continuing this uptrend. Sometimes what market will do is market will tap into these last breakout level, and from here market will continue higher, right? So why is that? The reason is very clear. That means that there is something over here which is reversing the market to continue the uptrend. And that POI is called a mitigation block, which is created when market creates a new break-off structure. So most people, those who are trading price actions, they call it a breakout and retest setup, right? So what they do is they buy once market comes down to test this last breakout level, and they target the last high, right? But as SMC traders, as somebody who trades market structure, we know that either market can come all the way down, tap into these order block, and from here market can push higher, that we already know. But today we are also learning that it's also possible that market can just tap the last breakout level, and from here also it can actually displace higher. Okay, why? Because we have got a zone over here, or a POI over here, which is called a mitigation block. What is it? It's a mitigation block. Now mitigation block is that candle which creates the last high before this push to the downside. So let's say market is pushing like this on the upside. We have got multiple green candles, one after another. So let's put some more candles over here. So this is how it is pushing higher. Let's say we get one more green candle, right? And then we see a red candle over here. Okay, we see a red candle over here. This candle that has created this high before going down, before giving this pullback, this whole candle is called a mitigation block. This is called what? It's called a mitigation block. Okay, this is called a mitigation block, and these blocks, they help to continue the trend. So whenever market will break out a level, this will be the first zone that you have to focus on, okay? Because this is also a very important POI, and this can actually help the market to continue the trend once it gets tested. So this is the first zone to watch for a reaction. And let's say market is not able to push higher from this zone, only in that case we will be focusing on the order block, which is the last zone for market to continue higher. And most of the times what market does is market comes all the way down to tap into the order block or the fair value gap, which is just above this order block, and market will push higher from here. Let me rewrite it as FVG plus order block. Okay, so you are considering both of them as one single POI, because once market comes down, market is either going to tap into the fair value gap and start reversing, or it can also tap into the order block and start reversing. Okay, but it also happens that sometimes market will just test this last breakout level. Like I told you, the price action traders, they call it a breakout and retest setup, and market will start to push higher and take out the last liquidity. So these will be the two zones that you have to watch for to look for an entry in the direction of the trend. Till now we have studied this zone only, which is the fair value gap plus the order block zone. But today we have also known that there is one more zone to watch for, which is the last breakout level, which gave the breakout structure. And the last candle before this selling, before this pullback, that whole candle becomes our mitigation block. And this block helps to continue the trend in its direction. So this is for a bullish market. The same thing will happen for a bearish market. Let's say market is dropping like this, gives a pullback, and then gives a new break-off structure to the downside. So we have got what? We have got a new break-off structure to the downside. Now we already know once market gives a pullback, then we'll be looking for an entry, and we have already studied about the POI, which will be order block plus fair value gap. So this will be the POI to watch for, right? And most of the times market will actually tap into the order block or the fair value gap along with it, and then market will drop once again because the trend is bearish. But sometimes what market will do is market will just tap the last breakdown level, and from here market will push to the downside and continue the bearish trend. So these zone, we have got a POI obviously, which is pushing this market to the downside, and this is what a mitigation block is. And once again, in this case, the mitigation block will be, let's say market is dropping like this. So there are multiple candles one after another, and the market drops to this zone. And here, let's say market gives another red candle, and once again the candle color of the mitigation block does not matter. This can be a red candle, a green candle, that does not matter. What matters is that this should be the last candle before the market pushes higher for a pullback. So this should be the last candle, and this will be our mitigation block. And after that, let's say market starts to push higher and starts to print green candles like this. So these whole candle will become what? Will become our mitigation block. Okay, so this will be called mitigation block, and this will help the bearish trend to continue to the downside. Yes, most of the times, like I told you, market will go to your order block zone to tap and give your entry from there, but sometimes market will also tap into the mitigation block, and from here market will continue in its direction. Okay, so this is very important. This is also one of the most important POIs to watch for along with order blocks. Okay, now let me show you some examples. I've already marked some mitigation blocks in the chart to show. So here I can see that I've marked mitigation block. So market was dropping, and I'll also tell you which mitigation block is a very strong mitigation block, is a very powerful mitigation block, and which one is a weak mitigation block. But before that, just try to understand what is a mitigation block. So here market was pushing down, market gave a new breakout structure over here, right? And after that, what happened? Market came up, tapped into this mitigation block, which was this candle. Now you can see what I have done is, and you can also do, I have refined this whole candle, this whole last selling candle, I have refined it to just the wick on the downside. You can also do that. So this is called refinement. So what you can do is, let's say market is pushing higher like this. Let's say we've got multiple green candles like this, one after another, and obviously they have wicks, but I'm not considering the wicks. And we got another green candle like this, and let's say we get another candle like this. Okay, and this candle has wicks like this. Okay, so we're just considering the wicks on the last candle, and after that, let's say market starts to drop or give a pullback. And obviously this is for buying. So let's say we get some more candles like this on the downside giving us a pullback, and after that market once again starts to push higher like this, giving us green candles. Okay, so in this case, let's say we get some more candles. So we have a new break of structure on the upside, right? So we have got a new break of structure on the upside. So you can mark it as a BOS, that means a break of structure. So in this case, we're looking to buy after market gives a pullback because the trend is bullish. Market has given us a bullish break of structure. So after a pullback, we want to buy. So in this case, what will be our mitigation block? It is going to be this whole candle, right? But what we can do is we can refine this candle and just consider the upside wick of this mitigation block. That's enough for us, and once market comes down, taps into this zone, we will be looking for an entry from here according to our entry models, and we will be targeting the last high, which will be our liquidity. Okay, so this will be your entry in case you are looking to buy. The exact opposite thing will happen when you'll be looking to sell. So let's say you are looking to sell. In that case, obviously the candle colors will change, and when you are looking to sell, you will be marking the wick which is created on the lower side of this mitigation block. That's what you will be marking when you are looking to sell. And when you are looking to buy, you'll be marking upper wick of the mitigation block, and from there you'll be looking for an entry. Okay, so this will be your refinement, and this is very important. Here also you can see I have refined this whole mitigation block into just this wick on the lower side, and that's where I'll be looking for an entry because the market is dropping, so it is bearish. It has given us a new break of structure to the downside, and you can see once market taps the zone, market reverses, comes all the way down to target our last liquidity, right? So here there will be two targets. This will be your first target because this is also a swing low, so this will also be your liquidity. So this will be your initial target, and this will be your final target. Okay, so this is how a mitigation block works. Let me show you some more examples. So once again, here I can see I have marked one for buying. So market gave a new break of structure. As you can see, this is a new break of structure. I'm not marking this, you can understand. After that, market comes down, drops, and once again this is the mitigation block, right? But I've just marked the upper wick of this candle, and market taps this, and then market tries to come down, but it cannot close below this mitigation block, and from here market reverses to the upside. Let's see some more examples. Here again, market was dropping. You can see we had this last candle before market gave a push, and then market broke the structure. So here we can mark the whole candle, but like I told you, we have refined this candle and we just consider the lower wick of this candle, and market came up, tapped into this zone, and from here market dropped all the way down to sweep out this liquidity. Right here again, market was bearish, it dropped, it gave a new break of structure on the downside, and these are all selling examples, and that's why we are marking the lower wick of the mitigation block, right? So here we have marked once again the lower wick of the mitigation block because we were looking to sell. Market comes up, taps into the zone, and from here market drops all the way down, but this would be our target according to the structure, right? So this is how a mitigation block works. It helps to continue the trend in its direction. Let me show you some more examples. Like I told you, we don't see a lot of examples all the time because market most of the time will tap into an order block rather than the mitigation block itself. Okay, so let's see some more examples. Here again, market gave a new break of structure, as you can see on the upside. So once market comes down, taps into this zone, we will be looking for an entry and will be targeting the next swing high or the swing low if we're looking for a buying or sell. Okay, here again we see a new break of structure on the upside. Market taps into this and then market pushes higher, right? So this is how a mitigation block works, and you can see here also market gave a new break of structure. This candle closed above this high. After that, market taps into this and market pushes higher and market takes out this liquidity. So this is how a mitigation block works. Here again, this was a mitigation block. Market came down, tapped into this mitigation block exactly, and from here market displaced to the upside and took out this liquidity, right? This one is for a selling. You can see market came down, broke structure to the downside. After that, market went up, tapped into the low of the mitigation block, and from here, market displaced to the downside. This is an example of a bullish mitigation block. You can see market gave a new break-off structure on the upside, and after that, market came down, tapped into the mitigation block, and from here, displaced to the upside to take out to our liquidity. Right? So this is how a mitigation block works. Multiple examples can be seen. This one is a selling example. This one is a buying example. You can see for selling, we have marked the low of this mitigation block. Market tapped into it and market dropped. And for this one, market gave a new break of structure on the upside over here. So market came down. We have marked the high of this mitigation block. Market tapped into it and market displaced to the upside. So this is also a very important POI that you see in the market, and it also gets respected just like order blocks. Okay, so keep this in mind. Mitigation block, this is also one of the most important POIs, and mark them on your charts as well along with order blocks. Okay, now let's talk about what is a strong mitigation block and what is a weak mitigation block. So I'm going to remove the order blocks because we are not studying about this. Okay, so market comes over here, right? And then market taps into this zone and market pushes higher. So now we will study what is a strong mitigation block. So strong mitigation blocks are those which has a fair value gap in front of it. That means what? Let's say that market comes down all the way to this point, and from here market starts to push higher like this. So we get multiple green candles like this, and then market breaks the structure to the upside, right? And this is how market continues to the upside, right? So now we can see that, let's say we have got a wick over here on this mitigation block. So now what we will do is, as I've told you, we are not going to mark this whole candle. We will refine it and we'll just consider the wick of this mitigation block. So we will be considering this, we'll be marking this, and in front of this mitigation block, if there is a fair value gap, in that case, this mitigation block becomes much more powerful. Okay, so in that case, there is a very high chance that market will just tap into this mitigation block and the fair value gap, and market will displace higher from this level and it will target our liquidity. So whenever there is a fair value gap which overlaps along with the mitigation block, that becomes a very powerful POI. Okay, in those cases, there is a very less chance that market will drop all the way down to the last order block before pushing higher. In those cases, mostly market will tap into these POI, which is a combination of a mitigation block and a fair value gap, and from here market will displace to the upside. Similarly, let's say market is bearish and market starts to drop from here. And once again, I'm going to remove this order block. So let's say we have got multiple red candles like this, and market drops like this, and then it breaks the structure to the downside. Let's say we have got a wick over here on this mitigation block, something like this. In that case, what I will do is I'll be marking the low of this mitigation block, and if there is a fair value gap along with it which overlaps with this mitigation block, in that case this will become a much powerful POI, and there is a very high chance that the market is going to tap into this POI and it is directly going to drop from here without giving a pullback all the way to the last POI, which is the order block, right? So this is an example of a powerful mitigation block, and whenever there is a fair value gap just in front of the mitigation block, that becomes a much stronger POI, and market will tap into this zone and immediately will get displaced from that zone. Okay, so let's see some examples of that. Here you can see that there was a fair value gap along with the mitigation block. So this becomes a very powerful POI, and market tried to break this POI twice, right? Here it tried to break but failed. Here again the sellers tried to come but they also failed, and ultimately market had to push higher from here. So this is a very powerful POI, one of the strongest POIs that you see in the market. Here also we can see that we have got this mitigation block, and just in front of this mitigation block we have got this fair value gap, right? So we can just mark this fair value gap zone which overlaps with the mitigation block, and you can see not a single candle closed above this POI. Market tapped into it and immediately got displaced to the downside. So you can say that this is the example of, let's say you want to break one single stick, right? So it's much easier. But if I give you a bundle of sticks, let's say I give you a bundle of 25 sticks, then that will become very difficult to break, right? So this is exactly what it is. The mitigation block in itself can be broken, right? Can be disrespected. But when there is another POI, which is a fair value cap, just in front of this mitigation block, then this becomes a very powerful POI, because then we are not just focusing on one single POI, but we're looking at a combination of two POIs, which makes this zone a very powerful zone. Okay, let's see some more examples. Here also we can see market gave a bearish break-off structure over here, and just in front of this mitigation block we had this fair value gap, and you can see market tapped into it and immediately got displaced to the downside with a massive red candle, right? So let's see some more examples. Here again, you can see we have got a bullish break-off structure on the upside, and we have got this fair value gap just in front of this mitigation block. Market taps into this and immediately gets displaced to the upside. You can see just a tap and a massive green candle on the upside from this POI. So you can see that this is a very powerful POI, which is the mitigation block plus fair value gap. This combination is a very deadly combination, and whenever market taps into these POI, market reacts immediately in a massive manner, right? So this is the example of a powerful mitigation block, and this is all about mitigation block that you have to know. Yes, most of the times market won't really react from them. Market will react from the order block because that's where the institutions have pending orders. But sometimes if market creates this kind of overlapping POIs like a mitigation block and a fair value gap, just like this or like this, you can actually focus on the mitigation block also, because market will react from these POIs and market will displace very quickly from there. Okay, now let's talk about breaker block. So breaker blocks are blocks which actually reverses the trend of the market. So let's say market was dropping like this. So market was bearish, right? It was dropping like this, and market comes down, taps into a POI, let's say, and after tapping into the POI, it gets displaced on the upside, giving market structure shift. Now, when that happens, what market will do is market will come down, market will tap into this breakout level, and market will start pushing higher like this. Now, in this example, see what happened. Market was dropping, and after that market tapped into a POI, gave market structure shift, and market started to push higher. So in this case, market reacts from this zone, right, which is the last breakout level, instead of coming all the way to your order block. You will see sometimes that this will happen, that after giving market structure shift, you are waiting for market to come down, tap into your order block and take your entry from there, but market does not come to your order block. Instead, it just taps into the last breakout level, and from there it starts pushing higher. So this is what a breaker block is, which helps to reverse the trend, and then market reverses and changes its direction and starts a new trend. Now, why this is more powerful than mitigation block? Like I told you, mitigation block only helps to continue the trend, but the breaker block helps to reverse the trend. Why? Because breaker block takes massive amount of liquidity before reversing its direction, right? As you can see over here, market was dropping and market was respecting these mitigation blocks, right? These are mitigation blocks which market was testing, and then market was moving in the downside direction. But over here, what happened was, you can see that we had a bearish break-off structure, right? So more sellers came into the market and they were looking for sell. Now, like I told you, there are two zones to sell. First, there will be retest traders will wait for this retest of the last breakout level, and they will be looking to sell from here and target this last low. So their stop loss will be taken, right? So their stop loss is taken, they have been liquidated. Then there will be order block traders who will be looking to enter from this position with the stop loss above the swing high. And once again, their target will be at this low, and their stop loss will be above the swing high, and they will also be taken. So you can see massive amount of sellers have been trapped over here, and that's the reason that this move to the outside is a very strong move. So whenever market sweeps the last low and market reverses and gives market structure shift, then market will come down and just tap into the last broken level and immediately displace from here. So this is what a breaker block is, and that's why it's more powerful than a mitigation block, because mitigation block just helps to continue the trend. So once this breakout happens, once this market structure shift happens, market will tap into this breaker block. So let me mark it as breaker. Okay, so market will tap into this breaker and market will push higher, right? So now we know that the trend has shifted from bearish to bullish. Now what market will do is, now market will come down and market will test this zone, which is a new breakout level. And now this will be what? Now this will be our mitigation block. So now you should be able to understand what's the difference between a breaker and a mitigation block. Breaker is the first breakout level just after sweeping the last low, which helps to reverse the trend. And once the reversal has already happened, then mitigation block comes in, and mitigation block helps to continue that trend in that direction. Once again, market will come down and market will tap into these breakout level, and from here market will push higher. So this will also be what? This will also be a mitigation block, right? So this is the difference between a breaker and a mitigation. Now let's see some examples in the chart. Now we do not really see breaker all the time, because like I told you, this only happens when market is about to reverse the trend, but I will still show you some examples. So here you can see that market was in an initial uptrend. After that it started to drop, and here you can see what happened was market created this low, then this high, and after that a new lower low, which has swept the last low, right? It has swept the last low, and after that what market does is market pushes higher and market breaks above the last high. That means now we have got what? We have got a market structure shift on the upside, indicating that this bearish trend is now going to reverse to the upside and it will become a bullish trend. So now the first breakout level will become our what? This will become our breaker block. Okay, so this becomes our breaker block, and this is where we'll be looking for an entry with confirmation using our entry models, stop loss according to the structural low, and our target will be what? Our target is going to be the last swing high, which will be the liquidity in this case. And this is how we take our entry from this POI, which will be breaker, to our liquidity, which is going to be this high. Okay, let me show you some more examples. Okay, so here I can see we have got another example. Once again, market was bullish previously, but after that market started to give a pullback. And here also the same thing has happened. Market was dropping like this, created this low, a new high, and after that market dropped to the low once again, sweeping the last low. And then what market does is market starts to push higher and market breaks above the last high, giving us a market structure shift, clearly indicating that the bulls are now back in the market, and now we can see this push to the upside. So what market does is market comes down, taps into these breaker block, and from here immediately reverses to the upside. So in this case, if you would have waited for market to come down to your order block, you would have missed the entry, right? So in that case, you have to mark this breaker block zones, and from here also you have to look for your entry. Okay, so let's look for some more examples now. So here I can see that there is another example, and once again market was initially bullish, but after that market gave a pullback, and when market had to reverse once again to the upside after this pullback, market created this market structure shift over here. Same thing that we have seen till now. Market created this high, then this low, which swept the last low. Now this is important. Sweeping the low is important, whether it's a candle close or just a wick, that does not really matter. If market recovers after that and breaks above the last high, then we have already got a market structure shift, and in that case the last breakout level will be our POI and will be marking this zone. And once market comes down, taps into the zone, we'll look for an entry and we'll be targeting the liquidity. right? So this is what a breaker block is, and whenever market reverses its trend after a pullback, you will be seeing breaker blocks. Okay, so this is what a breaker block is. Let me show you some more examples so that it becomes absolutely clear to you what a breaker looks like. And also after that, make sure that you go to your charts and look for this mitigation blocks and breaker blocks and see whether market actually respects these zones or not, and also look for entries from these zones. See if you can actually take entries from these zones using the entry models that we have studied till now. Here once again market came down. There was a massive drop to the downside, but once again the overall structure was bullish. This was just a correction of this entire push to the upside, and once again when market had to reverse to the upside, change its trend, what market did is market created a breaker block. You can see that market dropped, created this low, then this high, after that a new lower low, trapping sellers over here, and then a strong push to the upside, breaking above the last high, giving us market structure shift. After that market comes down, taps into the last breakout level, and from here market pushes higher. So once again your entry will be from this zone along with confirmation. Stop loss will go below the structure low, and your target will be the liquidity, right? So this is how you trade a breaker block, and once market breaks above the breaker block, you will see that the mitigation block comes into play. In this case, there wasn't any strong pullback into our mitigation block. So let's look for some more examples where we have got both breaker block and also mitigation block. Here you can see that we have this example where market was pushing higher, and after that market came down, gave us a pullback, or you can say a correction of this entire upside move, and then market shifted its trend from bearish to bullish, giving us a market structure shift over here. You can see we've got this low, then this high, and after that this low, which has swept the previous low, and then market pushed higher and broke above the previous high, giving us a market structure shift. And then market comes down, taps into this zone, and market starts to push higher. So once again we'll be looking for an entry from this breaker block along with confirmation, and we'll be targeting the liquidity, right? So this is how a breaker block works, and this is more powerful than mitigation block because it helps to reverse the trend. But once breaker block is created and it's respected and market starts to push higher, then what happens is mitigation block comes into play. Here you can see that market created a new breakoff structure over here. So here we have got mitigation block coming into play. So we'll be marking this zone, and you can see what happened. After market gave this new candle closing above this high, market came down, tapped into this mitigation block, and from here market pushed higher, right? So this is the difference between a breaker and a mitigation. Breaker is the first block which is created after market structure shift, and mitigation blocks are the blocks that are created on new breakoff structure after the breaker block, and it helps to continue the trend. Okay, but breaker block helps to reverse the trend completely. Okay, so whenever there is a reversal, first of all you will see a breaker block getting created, and after that, once breaker block has been created and market has respected that block and market starts to push higher, creating new breakoff structures, in that case you will see mitigation blocks coming into play. Okay, so that's all about breaker and mitigation, and they are also quite powerful POIs that you see in the market. But yes, most of the times market respects order block and the fair value cap, but sometimes you will see that mitigation and breaker blocks will also be coming into the picture. So you have to mark these POIs as well along with order block and fair value cap. So that's it for today's class. In the next class we'll be discussing about gaps, and then we'll be talking about liquidity.